Have you ever wondered how your residential status is determined under the Income Tax Act 1961? Well, you're certainly not alone. This seemingly complex process is actually more straightforward than you might think. It's a key piece of the tax puzzle that can have a significant impact on how much you owe to the taxman. Just think about it. Your residential status can dictate whether you're taxed on your worldwide income or only on the income you earn within India. It's a small detail with substantial implications, and understanding it can help you navigate the labyrinth of income tax with greater ease. So, why is it important to know your residential status? Simply put, it's all about ensuring you're paying the right amount of tax on your income. And trust me, nobody wants to pay more tax than necessary. Stay tuned as we unravel the process of determining residential status under the Income Tax Act 1961. Residential status, as defined by the Income Tax Act 1961, plays a pivotal role in the taxation of an individual. It's the foundation on which taxation builds and determines how an individual's income will be taxed. Let's consider it this way. Imagine a giant web, where each thread represents a different aspect of your financial life: your salary, your investments, your property, even your foreign income. All these threads come together at a single point: your residential status. This status is not about where you live or your nationality. Rather, it's about your financial connectivity to India. It's the central point where the taxman looks to decide how much you owe to the government. You might ask, why is this so important? Well, the answer is simple. Depending on your residential status, you might be taxed only on the income earned in India or on your global income. That's a significant difference, isn't it? The broader the tax base, the higher the tax you may have to pay. And here's the thing, your residential status can change from year to year. It's not cast in stone. It's determined by specific conditions and criteria laid down in the Income Tax Act. Now that we have a basic understanding of the importance of residential status, let's delve into how it is determined. Understanding this is the first step in smart tax planning and ensuring you're not paying more than you should. The first step in determining residential status is the physical presence test. In essence, this test is all about counting days. Your days of stay in India, to be precise. The Income Tax Act of 1961 has two specific rules for this: the 182 days rule and the 60 days rule. Starting with the 182 days rule, it's pretty straightforward. If you've stayed in India for 182 days or more in a financial year, you pass the physical presence test. This period need not be a continuous stay. It could be scattered throughout the year. But what if you haven't stayed for that long? Well, that's where the 60 days rule comes into play. If you've been in India for 60 days or more in a financial year, and have stayed for 365 days or more in the 4 years immediately preceding that financial year, you still pass the test. Now you might be wondering, why two rules? Why not stick to the 182 days rule? Here's the thing. The 60 days rule is essentially a safety net. It ensures that individuals who make short but frequent trips to India are not exempted from being considered residents for tax purposes. However, there are exceptions to the 60 days rule. For instance, if you're an Indian citizen working abroad or a member of a crew on an Indian ship, the 60 days are replaced by 182 days. The same applies if you're an Indian citizen or person of Indian origin who's outside India and comes on a visit. The rationale behind these exceptions is to provide some relief to individuals who are not permanently settled in India, but have to visit for brief periods due to work or personal reasons. So, the first step is all about how many days you have stayed in India, but that's not the only criteria. The next step involves understanding the different types of residential statuses. Let's delve into the realm of residential statuses. Essentially, there are two types. The first is the resident and ordinary resident, commonly referred to as ROR. The second type is the resident but not ordinary resident, known as RNOR. A person's residential status for a financial year is determined by their physical presence in the country during that year and the preceding years. The resident and ordinary resident status, or ROR, is assigned to those who have been physically present in the country for at least 182 days in the relevant financial year. Additionally, they must have been in the country for a total of at least 2 years and 465 days across the previous 4 financial years. If these conditions are met, the person is deemed an ROR under the Income Tax Act of 1961. Now, let's discuss the resident but not ordinary resident, or RNOR status. This is a bit more nuanced. A person is considered an RNOR if they have been a non-resident in India in 9 out of the 10 previous years preceding that year, or if they have been in India for less than 729 days during the 7 years preceding that year. In other words, if you've spent a significant amount of time outside of the country in the past decade, you might fall into the RNOR category. So, why does it matter whether you're an ROR or an RNOR? You see, your residential status affects your taxation. For an ROR, worldwide income is taxable in India. However, for an RNOR, only the income earned or accrued in India is taxable. Now we have a clearer picture of the types of residential statuses. But how does this affect our taxation? The final piece of the puzzle is understanding how these residential statuses impact taxation. The residential status of an individual under the Income Tax Act of 1961 is not just a label, it has significant implications for how tax is assessed. Each category, be it resident and ordinarily resident, ROR, resident but not ordinarily resident, RNOR, or non-resident, carries with it a unique set of rules and exemptions. For those classified as ROR, the global income is taxed in India. This means that if you are an ROR, you're liable to pay tax on your income earned both within India and outside India. It doesn't matter where the money is. If it's yours, it's subject to tax. On the other hand, if an individual is classified as an RNOR, they are only taxed on the income that is earned or accrued in India, and the income that is derived from a business controlled or a profession set up in India. The rest of their income, even if it is earned abroad, is not subject to tax in India. Lastly, non-residents are taxed only on the income earned or accrued in India. It doesn't matter if they earn millions outside India. Those earnings are off the Indian tax radar. But remember, while the scope of total income may differ, there are exemptions available to every taxpayer. These exemptions are designed to provide relief and encourage investment and savings. For instance, certain types of income, like agricultural income, are exempt from tax for all residents, while other exemptions may be available only to non-residents. It's also crucial to remember that India has double taxation avoidance agreements with several countries. This means if you're paying tax in one country, you may get relief from taxation in the other, depending on the terms of the agreement. It's like a game of chess, where every move can change the state of play. Your residential status is one such move that can significantly impact your tax liability. So depending on your residential status, your tax liability will differ. Determining one's residential status under the Income Tax Act 1961 is not as daunting as it initially seems. We've journeyed through the various aspects of this process, so let's take a moment to reflect on what we've learned. Firstly, we delved into the overview of residential status and its importance. As we've seen, it plays a crucial role in determining the tax liability of an individual. It's not about your citizenship, but rather where your income is earned and where you reside. Next, we examined the physical presence test, a significant part of the residential status determination. Remember, it's all about the number of days you've spent in India during a specific financial year and the preceding 4 years. We then moved on to the different types of residential statuses: resident and ordinarily resident, resident but not ordinarily resident, and non-resident. Each status has its own unique set of rules and tax implications. Finally, we explored how these residential statuses impact taxation. It's essential to understand that your residential status affects not only the income you earn within India, but also your global income. In conclusion, the process of determining one's residential status is a critical aspect of understanding your tax obligations. It's a nuanced process, but once you've grasped the basics, it can significantly impact your tax planning strategies. Remember, understanding your residential status is the first step towards effective tax planning. Stay informed and stay tax savvy.